Yeah, listening felt super important to me in that I had learned these skills through my job of how to ask good questions. What's up, guys? What's up? What's up? I said I might come back, and here I am. It's 2:30, so I figured I'd be here just before the market closed. Market closes in about 30 minutes, and so I am here to see what this market can do here in the last 30 minutes. In the last hour or so, we've seen some incredible shifts and changes with the market. It's honestly a little fascinating to watch what's going on. We're going to actually switch the TV over here to CNBC, as we like to do here in the afternoon. Let's see. Is this going to play nice with me? Oh my gosh, looks like I might have a frozen think or swim app. Let me see, guys. Come on, think or swim. Come on. Every now and then when it does this, it'll pop back into gear. If not, I might have to close it and reopen. Ay. All right, let me close and reopen here just briefly. So I'm going to close that. So you guys can now see me, but you can't see everything else. There you go. I'll make me a little bit bigger so you guys can really love looking at me. And close window. This is always happening. Let's go. We might have to Control Alt Delete this guy. Oh man! All right, don't go anywhere, guys. We are here. Thinkorswim desktop application in task. All right, we are back in. Yes. All right, we are loading. Stay with me, guys. All right, anyway, so while that's loading, I'm going to talk about what happened just in the last hour. Of course, I was not in front of my computer, but I was watching what was happening from my phone, and it is an interesting last hour for these stocks that we're following here. Most notably, GameStop and KOSS. I think those are going to be the two that have shown the most life here. Come on, Thinkorswim. It's thinking. Now it needs to swim. Encoding overloaded. Consider turning down video settings. All right, come on now. We're almost back. My dashboard's loading here. Anyway, what we're talking about here is GameStop. GameStop has just had a terrible day. It was down like 11% at one point for a long time, or for the session. It's gone down to 135 as it's low after actually opening and trending up right at the open. We went down 16% from its highest amount. And then very quickly from its bottom, it bumped up about 10 or 11%. All right, looks like we might be in business, boys. Let's see here. Let's turn this on. Boom! And we are live. All right, guys. We're back. That's what's when we come from. So anyway, let's see what we're looking at these stocks that we're seeing. We're seeing TQQQ. Let's switch these. So go back to the old settings. TQQQ. Let's put TQQQ on the bottom left. We're going to put GameStop on the top. So you can look at this huge surge, two big surges actually in GameStop today. One right here, huge volume surge. We're going from 139 to 146 within a matter of a couple minutes. Then it just bottomed right back out to 135. Then happened again, it went from 140 up to 152 within a matter of a few minutes, and it's back down to 146. Does this mean it's back, or does this mean that it's just going to take deeper like it just did? I'd be really interested to see. I don't think it's going to get back down to 135 or so before 3 o'clock, but will it get there tomorrow or after hours today? It's interesting to see what we're seeing with these guys here in the afternoon. Just the life that's left in it. Look at AMC. AMC is going to have the worst day. Probably have the worst closed than GameStop, but it is not showing this boost at the end. What it had is it was boost back here, went from 851 up to 889 in a few minutes, and then it's twisted a little bit of a boost, but not much. So interesting day for AMC, but there's no chance it can jump. I don't know. I mean, is there going to be another big jump for GameStop before the end of the close? I don't know. I don't know. It makes no sense. So now it's going up again very slowly. Up to 6.84 down. It was down a lot there. It opened at 158, went down to 135. It was a bad day. A little bit of similar boost here at cost, not quite as dramatic as GameStop's. And then Express is just not great today. They had a couple small runs, but not great. Some 3.56, not good. So QQQ, we're seeing it being mostly sideways today. A little bit of a run up here. Went up to 107, but back off to 106. So it's just under that. Overall, the market's down. Nothing crazy. It's going to be a relatively sideways day, just like we've seen this weekend. That was actually specifically mentioned the in TD Ameritrade this morning. I'm talking about just everything's just kind of sideways and it's been that way for about a week and a half. Haven't seen any dramatic volatility in the overall markets, but we have seen record closes. We have seen some gains, so that's really good. I have also seen Voyager taking a dip here this afternoon. It's kind of an interesting one because I've been watching it and had not dove into Voyager, but I've been watching it from a distance. And I feel like it might be an opportunity. I really wanted to get in before the Coinbase IPO. It might be, there might be some Let me see. What I really want to do is get some cash. I get some cash available to do that. And I do have some stocks that I'd be willing to dump. I dumped Biotech the other day. The other one I have is FTCV. It's down today. It's a bummer. I really wish I missed out on selling it at 14.99. I could sell that 13.99. Which one is that? 15 times 14. $700 worth. I'd still make money on it, but whether I want to sell it now or wait to see if it goes up tomorrow. Nvidia, man, look at Nvidia. Heck yeah, man, that's finally now turned into a profit. Invested in that kind of at the peak, unfortunately, in early March. Anyway, I'm down slightly today, but nothing crazy. Anyway, let's watch this. Let's watch closing for the rest of the day.
Into multiple categories. We expand into drinks with more and more stores opening. We got a great sized business in the cannabis business in Canada. In Europe, with medical cannabis expanding in different countries, whether it's France, whether it's the UK, whether it's Spain, Portugal, Germany, etc., we got a great sized business, in Europe to grow our business, both in medical and the opportunity for recreational. In regards to the U.S. market, listen, we're seeing some great results coming out of Sweetwater. In regards to Tilray, they own a company called Manitoba Harvest with CBD and hemp-based products in the food category. Not knowing when legalization happens in the U.S., I want to continue to acquire certain businesses like a Sweetwater or like a Manitoba Harvest that can parlay into the cannabis world once legalization happens, with great margins, great growth, and great distribution for us.
Well, the vote on the Aphria Tilray is this week, which is obviously a huge deal for you. Erwin, also wanted to play you a soundbite of a clip of what Uber CEO Dara Khosrowshahi said about the pot business earlier today on CNBC. Listen to this.
When the road is clear for cannabis, when federal laws come into play, we're absolutely going to take a look at it. But right now, with grocery, with food, with alcohol, et cetera, we see so much opportunity out there, and we're going to focus on the opportunity at hand.
Erwin, just noting the openness, I think, for a company like Uber to be getting into cannabis delivery. Do you welcome that? What's your reaction?
Listen, I absolutely welcome that. And I think we have similar strategies, is ultimately There's many opportunities in the U.S. right now with food and drink and other consumer products. And I know about how to build consumer brands and parlay that into cannabis once legalization happens. And the thing is, Sarah, I'd rather be doing that and building upon the brands that I know I can get a distribution into convenience store, club stores, mass market, because we don't know once cannabis legalized if there's a one-tier system, two-tier system, or three-tier system, and what legalization is going to look like. So I'd rather have businesses like Sweetwater that have great margins, great growth opportunities, are skewed towards millennials that can ultimately parlay into the cannabis or THC market once legalization happens.
Is it going to come first in the U.S. or Europe? What's your expectation?
Listen, if I was a betting man, I think you're going to see legalization happen in Germany, Portugal, before you see recreational cannabis legalized in the U.S.
All right. We'll hold you to that. And I'm sure we'll talk to you in between. Erwin Simon, thank you very much for joining us. CEO
Thank you
of
very
Aphria.
much.
Wilfred.
Thank you.
Up next, much more on today's chip news, and one hedge fund laces up for a retail activist battle. Those stories and many more when we go inside the market zone next. We are just negative on the S&P 500. We have 13 minutes left in the trading day. We're now in the closing bell market zone. Commercial-free coverage of all the action going into the close. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. And today we've got Bespoke's Paul Hickey with us as well. Very good afternoon to you, Paul. Let's kick things off with the broader market. Stocks under pressure after posting weekly gains last week. The S&P 500 hit an intraday record high earlier before dipping lower. The Dow, though, has been negative all session. It's down 135 at the lows. Had a decent final hour of trade. In fact, we're going to come to that trend later, but Paul, I might as well kick off with that because we're seeing it today. We certainly saw it on Friday, and the trend in the final hour has been impressive of late. CNBC senior markets commentator.
Yeah, you guys must be doing something right. What we've seen is the first quarter. We saw one of the weakest last hours of
Let's kick things off with the broader market. Stocks under pressure after posting weekly gains last week. The S&P 500 hit intraday record high earlier.
The weeks, so 2 Fridays and the Thursday before Good Friday,
been negative
we saw big surges even heading into a weekend. So
at the lows. Had a decent final hour of trade.
A signal of
we're going to come to that trend later, but Paul, I might as well
appetite to hold equities and be comfortable holding overnight and into the weekend. So that's a positive sign.
Mike, if you look at what is ticking up higher, consumer discretionary banks ahead of earnings, consumer staples, real estate, you've got energy under pressure, and technology really is the laggard. What does that tell you?
I don't know if there's a lot of evidence for the future in the sector breakdown today. Really, I see it more as it's a slowing down of the market. The market is definitely comfortable at these levels. Not a lot of selling pressure.
As well, those are the primary big brains in most computing devices. Investors saw that as a direct shot at Intel, which did drop on that news. Though tech analyst Patrick Moore takes the other side of that trade.
Sure, the gain in Microsoft today. I think that purchase new ones. Market's proven that that's a good decision. But a lot of other things going down, that's kind of up. Yeah, Walgreens is still going up. I got to figure out Walgreens, man. I got to figure out if I need to put some money in Walgreens. Honeywell, heard about it. Lots of big name companies are doing really well today when the overall market's down. So, and FANG stocks off of Facebook. So interesting day today, but it's kind of the opposite of what was happening last week. For the most part, nothing's really volatile. The downs are not down much. The highs are not bad. It's very sideways up.
Now, and so I think you probably won't be hurt too bad here after this decline. For the semis in general, though, I mean, all the talk today is about shortages, and we're going to have shortages for the next few quarters. For the semis in general, a lot of investment being announced in the last few weeks. Taiwan Semiconductor, $100 billion over 3 years. Intel announcing $20 billion in capacity. Samsung spending $116 billion for new capacity between now and 2030. These are long-term trends, but I mean, people forget back in the 90s you had boom and bust cycles in the semiconductor space, and so there's definitely shortages now, and it's positive for the sector overall. But those shortages with this increased investment are going to probably turn into a lot of capacity down the road.
Mike, where's the SMH sitting at the moment? I mean, I guess it pulled back late February sort of time, but back close to highs again.
Yeah, it's a couple percent below the highs. It has not really given up much of the sort of margin of outperformance that it had beforehand. But I was just really to kind of reiterate what Paul said in terms of very big picture, what it means when there's just an enormous amount of new capital investment in any industry. It's pretty hard for economics to work if that doesn't over time bring on more capacity and maybe lower returns. Obviously, they're not going to be shared equally among all the different companies. Obviously, we're going to be using more, not fewer semiconductors down the road. So it's not like, CapEx in the oil patch when perhaps we're going to be using less oil over time. But I think people should be mindful of that. That's usually the dynamic in how these things play out.
8 minutes left as we stand. S&P 500 just positive. Food shares higher after a big increase in demand last month. Idris has got the details of that for us. High D stand S&P 500 just positive.
Well, demand is booming, but supply remains a problem. And I asked CEO Dr. Khosrowshahi if the $250 million green driver incentives already earmarked is enough, and is he prepared to spend more?
If the $250 million
We're absolutely looking to balance supply and demand, and if we need to continue to lean in to bring drivers out into saving earnings opportunities, we will need to continue to lean in.
Now that could mean more costs ahead amid fiercer competition, and remember that pledge to reach adjusted EBITDA profitability by year end. There's also the potential costs and existing costs of a changing regulatory landscape. So I also asked Khosrow Shahi about gig worker classification.
We want to give drivers what they want, and over again, drivers in the U.S. or drivers in the U.K., all over the world, they want the flexibility that comes with using their system. And drivers in the U.S. or drivers.
Now, we've heard that from Uber before, but a number of labor experts disagree with that flexibility point, and the tide may actually be changing. European rival JustEatTakeaway.com is bringing on drivers as employees. And remember, Deliveroo's recent IPO was a bust in part because of its labor practices that are more in line with Uber.
Yes, lots of issues though with the Deliveroo IPO, as you know better than most. Dean, thank you very much. Great stuff on Tech Check earlier. We're looking forward to it tomorrow and forevermore going forward. Mike, quickly on Uber's share price. Again, it pulled back for a couple of months, kind of was plateauing, as it were, but also only a percent or so from record highs.
Yeah, it's clearly been granted survivor status. Obviously, through this whole crisis, the company has come out proving that it can operate through it, and obviously as an answer in the delivery business, at least for continued top line growth. The way I would look at it is point to point. We're approaching the 2-year anniversary of the IPO of Uber. It traded as high as 46, in May of 2019, and here we are at 59. So yeah, it's up a lot off the lows, but in general, I think it's much more been kind of a sideways story, certainly relative to the overall market, and it shows you, I guess, the generous valuation it got out of the gate more than it does anything that Uber has necessarily not done right along the way, even though big picture, the business model is not fully proven in terms of bottom line profitability.
Dow recovering, only down 27 points. First it took aim at Kohl's and Bed Bath & Beyond. Now activist investors Legion Partners is taking on another retailer, Courtney Reagan, with the story.
Hi, Sarah. So Genesco is Legion Partners' latest campaign, pushing the stock up more than 4% today. Legion currently owns 5.6% of the footwear retailer. Genesco and Legion is nominating, 7 directors to the board, 5 of which are women, and Legion wants current CEO Mimi Gonder to stay. This is Legion's second investment in Genesco in recent years. In 2018, it got 2 members on the board, at least for a bit, including one of nominating again. Shares went up, and then Legion exited that stake. Genesco is one of 35 investments since Legion's inception in 2012, including Bed Bath & Beyond in 2019 and cybersecurity firm OneSpan in 2020. You may not know the name Genesco, but you likely know its businesses like footwear retailer Journeys and long-standing brands Johnson and Murphy. So the investor basically says that Genesco's current board has allowed long-term underperformance in the share price and operations, misallocated capital, bloated expenses, and overcompensated executives. Genesco says it disagrees with many of Legion's points, but that it will continue to seek constructive dialogue with Legion like it would with any other shareholder. We're waiting on the official date of the shareholder meeting. That goes to you guys.
It's so interesting, Courtney, because you would think that retail's been so ripe for activists to come in for a long time. There have been so many weak links, and yet we haven't really seen a ton of it. So these moves are noteworthy. Genesco, though, it's less than $1 billion market cap, less than 800 million market cap. So any implications for Kohl's, which is the big fight that Legion is trying to take on, so far to no avail, but that's more like a $10 billion company market cap.
Yeah, and it's interesting that Legion, Sarah, actually is one of the few activists that we've seen involved in retail, to your point, in the last number of years. And yes, Genesco is much smaller than Kohl's, and Legion is going in with Genesco alone as part of a 4-group consortium like with Kohl's. I mean, look, they've had success at Genesco before. I'm not sure exactly what the outcome will be. It seems fairly unlikely that they would reslate almost an entire board, either at Kohl's or at Genesco. But these guys do have a history of some success in getting retailers to pay attention to at least some of to listen to, as KOSS needs to listen to Legion and the others as well, at least just to hear their ideas. And really, when you think about it, right, the goal for everyone is the same, is to get that share price to go higher. That would be the goal for the company and the goal for the activists, which of course are holding on.
Cool. Thanks so much for that. And worth pointing out that both consumer discretionary and consumer staples are two of the best three sectors today, up about 0.5%, 1.4%. 2 minutes left of the trading day. Mike Santoli, what are the internals showing you?
Yeah, very, very mixed under the surface. What I mentioned earlier, that the number of stocks going down exceeds the number going up. If you look at the volume split on the stock exchange, it's kind of even at this point in terms of advancing decline. Actually, the declining is now outpacing almost 1.9 billion shares versus 1.1 advancing. Again, this has been one of these themes. Market's been kind of slowing down, pausing, allowing a lot of stocks to correct. Overall, not costing the market much. You mentioned consumer staples versus discretionary. Look at the equal weighted versions of both of those sectors on an intraday basis today, and you actually will see the outperformance here of consumer staples. And this has been a very, very quiet, perhaps early theme where you do have a little more money rotating toward the stable and sort of quality sectors of the market, dividend payers, things like that. So today you had something like General Mills up 1% on noon. Just really a mean reversion trade probably. And then the volatility index has been a big story once it is broken below, not just 20, but 18 and now 17. It has drawn in these funds that wait until volatility calms down before they take larger equity exposures. That's very well underway at this point. One of the last big groups there that had not really been chasing its market high.
Less than a minute to go before the close. The Dow has had a bit of a recovery here into the close. We were down more than 100 points moments ago. We're down only 43. Biggest drag on the Dow right now is Intel, which we've been talking about. NVIDIA coming to take some business there. Boeing, Salesforce, Apple, also some weights on the Dow. The biggest gainer is actually Honeywell and Home Depot and Nike. As far as the S&P 500 is concerned, you've got strength in groups like consumer discretionary, financials, and consumer staples. Weakness in energy, communication services, and technology. We just crossed into positive territory, now negative. We're basically flat. Made a few attempts at positive today. But keep in mind, we're trading at record levels. Nasdaq down about 0.25% as technology lags. Names like Apple, Intel, Google, AMC all weighing there. And small caps down 0.25%. Treasury yields a bit higher. The dollar's weaker, and Bitcoin at $300. Wilfred.
Just negative, it looks like, at the close on the S&P 500. Still settling, so there's a chance it'll dip back positive, jump back positive, but at the moment down 2 basis points. Welcome to the closing balance run. I'm Wilfred Frost, along with Sarah Eisen and Mike Santoli, CNBC senior markets commentator. It does look like a negative close on the S&P by 2 basis points. The Dow down by 54 points or so. The low of the session was down 135. So a decent final hour of trade, as you can see there, for the S&P 500. Briefly green, not quite at the close. Nasdaq Composite down a third of 1% at the close. So small declines essentially to round off the day here on Monday. Consumer discretionary, the best performing sector, followed by real estate. At the bottom of the pile was energy, and then tech and communication services, the other two sectors. Consumer discretionary, the best. Coming up, we will discuss the White House's chip summit and what the government could really do to rebound the U.S. semi industry. When we're joined by former Cypress Semi CEO Jay Roy. Coming up, we'll discuss that conversation. Paul Hickey from Bespoke Investment Group is still with us, and Ali McCartney from UBS Private Wealth joins the conversation as well. Good afternoon to you, Ali. Mike, I'll come to you first, and as you said with the internals, only slight declines on the surface, but a couple of other cracks beneath the surface, including the VIX picking up. I'll come to you first.
Yeah, the VIX did bounce out. Sometimes that's the Monday effect after markets being closed for the weekend. So I don't think it's necessarily showing too much stress. It's just a market that really is in the very short term in a lull. I mean, today was basically a push on the index level between the bulls and the bears. Although the S&P has had this pattern in the last couple of weeks of finishing higher than it opened almost every day. So there still seems to be kind of net demand to be involved, even though the market does look somewhat overbought technically, even though it does seem as if equity exposures are pretty high, and we have largely priced in at least the consensus, positive view in the short term. So I think that's where we get these opposing currents that on a daily today, before we're expecting a big rush of economic and earnings news, you get a little bit of a turn.
Ali, what do you expect for earnings season?
We think the market is very biased to the upside, and the earnings season and the numbers that we're going to see are really going to highlight that, right? From a technical perspective, we have about 80% of the S&P trading above its 50-day average, so anybody
flip side, Paul, have expectations and share prices, particularly for some of the cyclical sectors and stocks, risen quite a lot in the last month as we approach
Well, so it's pretty interesting. So analyst revisions have been to the upside heading into this earnings season. Typically, when you see that, it tends to be a bit of a headwind during earnings season. It doesn't guarantee that the market's going to go down during earnings season, but you're much more likely to have a positive reaction to earnings when you have expectations going down during into earnings season. But what's interesting about this period is, despite the fact that the S&P is at record highs, as Mike has been talking about regarding breadth, a lot of stocks underneath the surface haven't been nearly as strong as some of these mega caps. So we're sort of working off a little bit of the froth that we've seen in some of these names from their rallies from late Q4 and early Q1. So whereas last quarter we saw very strong results relative to expectations, this quarter and very negative share price reactions. This quarter we're still likely to see very strong results relative to expectations, but maybe we'll see more of an improvement in those share price reactions because the stocks have, some of these smaller names have gotten beaten down a little bit as opposed to they're not nearly as close to their record highs as the S&P is overall.
Deal news today, Microsoft announcing it will be buying the speech technology company speech recognition platform, Nuance Communications. It's a deal worth about $16 billion. Earlier today, Microsoft CEO Satya Nadella joining CNBC discussing whether he's worried this deal will be a red flag for regulators concerned about privacy and data security.
On the aspects of regulation and privacy and security, these are super important topics, obviously, in this particular context of the deal, as well as the segment called in healthcare. This is all about providers, patients, doctors, and their data. And our job is to provide technology so that they can, in fact, keep all of that data secure. Use even the AI that gets created on top of the data to benefit healthcare. So this is not about some aggregation play. This is about pure platform providers.
I think it was notable that Microsoft finished higher, or at least flat, did not go down, even with some questions about the price they paid, Ali. I know you don't talk specific stocks, but does this fit in with any of your themes in the market, whether it's deal making or healthcare tech?
Absolutely. You've just alluded to two of them, but I think this is a fascinating buy. We look at AI basically as the next technological and industrial revolution, how it is going to affect everything from supply chain management, healthcare, delivery, you name it. And, Satya was talking about part of that. And so when we talk about investing in secular themes and doing it in whatever way you can, either through private markets or public markets, this is exactly what we're talking about. This is going to take a lot of these stocks that are looking for a catalyst to have the next leg up to that. This is exactly what we're talking about.
Paul, what's your take on Microsoft specifically, but some of the other big cap tech stocks which are back in vogue, I guess?
Yeah, so Microsoft is a name we like and we own it for our clients. And what the interesting thing is here is we've been so concerned about inflation and higher rates hurting these growth stocks for all of March. And then what happened at the end of March, early April? We saw one of the largest gains, month-over-month gains, consumer confidence stock records. We saw nearly a 40-year high in the ISM manufacturing. We saw a record high in the ISM services index, and we saw job growth strong and CPI hit the highest level since at least 2010. Given the concerns over interest rates and inflation, that kind of data you would have expected rates to go higher. Yields have gone down on the 10-year during that time, and I think the market is at least either coming around to the Fed's view that inflation is going to be temporary, or at least the Fed is so determined that inflation is going to be temporary that they're not going to do anything about it for some time. And that helps breathe some light into these growth stocks and the tech sector, which is what we've seen over the last several weeks here as the mega caps have started to rally and some of these value stocks have fallen out of favor temporarily.
So Ali, I think you're a fan of value and small caps, even though they've been hit a little bit lately. Is that still the case?
That's still the case. Actually, we had a bias on value versus growth about 2 weeks ago, and given some of the sort of intra-sector things that we've been seeing in the market, which again Mike has touched on all day and all month, we are value over growth. We're tilted towards cyclical. We continue to like small caps. We also, a couple interesting things I think were said in the is margins and inflation, right? So I think we've all been talking about, I'm privileged to have a lot of clients that run these organizations, and they are telling me that their transportation and materials input costs are going up. And so what we need to see to keep this going and to keep the cyclicality and value there are to see that their ability to continue to stay on top of pricing and to increase margins is significant. I think that we will see that, and I think that that's further going to push into earnings expansion and value, and you're going to see some of these dividend names go up. You're going to see buybacks get fueled. It's all going in that right direction into earnings expansion and value.
Paul, I just wanted to ask about this apparent decline in market participation by retail investors in recent weeks, and indeed in volumes in general, and if that's a warning sign or not. What's your take? Decline in market participation?
Yeah, so there's an old saying in the market, never short a dull market, and I think there's a reason for it if you look back historically. If you look back, say, go back 10 years, more than 100% of the S&P 500 gains, so all of the S&P 500 gain and more has come on days when volume has been below average. So volumes have declined a little bit over the last week here, and that's raised some concerns that these retail investors tapped out and or moved on to other things. But when you look at the statistics, all of the market gains come on weaker than average volume. So I think since 2010, the S&P is up 225%. If you had only been exposed to the market on below average volume days, you'd be up 1,900%. And if you were exposed to the market on above average volume days, you'd be down over 80%. Usually declines come on strong volume and gains come on below average volume. So I wouldn't read too much into that fact that we're just, that the market's just slowly drifting higher rather than some sort of frenzy. And I think if you really did see an explosion of volume, that would be a sign maybe that people are getting too enthusiastic towards the market, whereas now we're just seeing a steady trudge higher.
Paul Hickey, Ali McCartney, thank you both very much for joining us. Good to see you.
Thank you.
The big banks are set to begin reporting quarterly results on Wednesday, and our next guest says consumer finance should be the star of the earnings season. She lays out her top picks, which may surprise you. Coming up, plus ARK Invest genomics analyst on the stocks that he is most bullish on in the genetic testing and biotech industries. We're back in just 90 seconds here on Closing Bell. Plus ARK Invest genomics analyst on the stocks that he is most bullish on in the genetic testing and biotech industries. We're back in just 90 seconds here on Closing Bell. Plus ARK Invest genomics analyst on the stocks that he is most bullish on in the genetic testing and biotech industries. We're back in just 90 seconds here on Closing Bell. Plus ARK Invest genomics analyst on the stocks that he is most bullish on in the genetic testing and biotech industries. We're back in just 90 seconds here on Closing Bell. Plus ARK Invest genomics analyst on the stocks that he is most bullish on in the genetic testing and biotech industries. We're back in just 90 seconds here on Closing Bell. Plus ARK Invest genomics analyst on the stocks that he is most bullish on in the genetic testing and biotech industries. We're back in just 90 seconds here on Closing Bell. Plus ARK Invest genomics analyst on the stocks that he is most bullish on in the genetic testing and biotech industries. We're back in just 90 seconds here on Closing Bell. Plus ARK Invest genomics analyst on the stocks that he is most bullish on in the genetic testing and biotech industries. We're back in just 90 seconds here on Closing Bell. Plus ARK Invest genomics analyst on the stocks that he is most bullish on in the genetic testing and biotech industries. We're back in just 90 seconds here on Closing Bell. Plus ARK Invest genomics analyst on the stocks that he is most bullish on in the genetic testing and biotech industries. We're back in just 90 seconds here on Closing Bell. Plus ARK Invest genomics analyst on the stocks that he is most bullish on in the genetic testing and biotech industries. We're back in just 90 seconds here on Closing Bell. Plus ARK Invest genomics analyst on the stocks that he is most bullish on.
This time last year, investors were fleeing the banks. Now analysts see the sector as one of the better bets on the street. The big banks will kick off earnings season on Wednesday. I can't wait. Joining us to discuss, Betsy Grassick, Morgan Stanley's US large cap banks analyst and the global head of banks and diversified finance research. Betsy, good to see you. Thanks for joining us. Joining us to discuss, Betsy Grassick.
Thanks, Will, for having me on.
US large cap banks. So first big picture question, to what extent have share prices and also expectations risen a little bit too much over the last few months, not the last few weeks perhaps, where share prices have pulled back a bit, such that it's quite a hard setup this earnings season? A little bit too much.
Oh, Will, that's a great question, but I have a slightly different point of view. I think that you're going to see bank earnings beat consensus. We're sitting here, several percentage points above consensus in our outlook, and our expectation is that it's much more likely that our estimates are sitting here rather than the other way around. Consensus in our outlook,
and your particular focus is towards consumer reopening names, even if the investment banks that did so well last year might have a good quarter too. And your particular focus is
that's right. Look, there is many different cylinders that are firing here, and I've been looking at this group for many years. In particular, U.S. large cap banks, about almost 20 years, and I have never entered an earnings season where there is so much positive going on. And in particular, it's around a handful of things. Number one, consumer credit, fantastically good. Yes, stimulus is part of that reason. Consumers have also been very prudent with how they've been receiving prior stimulus. And as you know, the jobs numbers have been improving here for the last several months. So we are looking at consumer lending and consumer credit being in very good shape. In addition, we expect that will drive bigger reserve releases than we have currently put into our models. And as a result, we get faster buybacks sooner. So putting all those things together, I think we'll see an uplift in the outlook for EPS as we move through this earnings season, most particularly to your point in consumer finance. But then also the capital markets, as you know, is very strong in our trading numbers. We have trading estimates up at about 10 to 15%, depending on what company we're talking about year on year. We entered this year looking for trading to be down year on year, but that's been a turnaround in our view the past quarter.
So Betsy, particularly within the consumer finance area that you like, which names look cheapest relative to your trade expectations?
So our outlook, our two top picks going into the quarter, Synchrony Financial as well as Capital One. There's about 12 to 15% upside in those names. For our base case, for our bull case, it's closer to 25 to 35%. And I do think the direction of travel here is towards the bull case. I think we could end up with our outlook for 2023 estimates coming sooner in 2022.
On the capital market side of things, Betsy, I guess it's not all good news, particularly in recent weeks with the Archegos blow-up. I mean, is that a story, obviously you can't talk to it for Morgan Stanley, but perhaps for Goldman Sachs and the other banks that decided not to do business with the blow-up. But is that a story that we are all focused on in the media much more than the analysts, or is it a significant issue from your perspective for risk management and potential bottom line losses? We are all focused on.
From our view, and to your point, I do cover Goldman Sachs, and our view here is that for Goldman Sachs, we're going to have an up year on equity trading year on year, similar to the other stocks I cover like JP, as well as Citi and B of A. In terms of, the question that you're asking around risk management, I think this is a question that management teams are, constantly being tested on, reviewed, dug into, and so I don't think that this would end up in a different situation than any others where you're going to see, reviews and that kind of thing. Basically that is really no different from any other quarter that we have. As it relates to earnings, why I think trading is actually going to be up is because look at what's been going on in the markets, the IPOs, the SPACs, the market valuation increase. So those drivers are outweighing some of the challenges that you mentioned.
Betsy, overall, just given the remarkable amount of money that the federal government has dispersed in stimulus checks and unemployment benefits, what do you expect to see on deposits and loans?
So deposit growth is extremely strong. Now, that's not because anybody is necessarily doing a great job marketing themselves, right? It's because the government is creating money through the stimulus and the QE, like you mentioned. So we do expect deposit growth will be in the mid-teens, maybe even the low 20s, depending on the bank. stimulus checks go out and significant QE activity has been going on, as you know, for the past year. Some of the biggest increases have been in the major banks like B of A, JP, Citi, et cetera. In terms of loan growth, that is the one cylinder that is not really firing right now. And that's mainly because, to your point, if you are getting stimulus directly from the government, maybe you don't need to borrow right now. So we are anticipating that loans will be shrinking slightly, most specifically in credit cards. And we expect to see the best asset class for lending in auto finance.
It's going to be a fun one for Wilfred. Betsy, thank you for joining us to preview Betsy Grayson on the bank. Let's go back to Mike Santoli now for a closer look at expectations overall this earnings season. Mike.
Yeah, Sarah, it's an unusual but not unprecedented setup where we've actually had earnings forecasts for the current year going higher going into the first part of the year versus lower. So this is the historical average path of earnings forecast for the subsequent year starting in September, according to Credit Suisse. And this is what we've seen for 2021. Obviously, we've got vaccines in here, we have all the stimulus hitting, and we have just general upward revision of GDP numbers. And also, the great earnings in the past 2 quarters, they get carried forward here. So we did see this in 2018, but that was strictly a tax cut kind of statistical effect. Before that, it was 2010 and back in 2003-4. So in other words, coming out of recessions or earnings downturns, you often do see the analysts are behind and they have to raise, but that also could suggest it's in the price. Because 2010, you had some choppiness after the first part of the year. And this is earnings revision for us. So the number of earnings estimates going up versus down, this is the netting out of that. And you see it's kind of flattened out, chopped down, it's kind of looking like it's peaking. It's according to Morgan Stanley, and that could suggest that we've seen the best of this upward revision. So that's why I do think guidance and sector and stock-specific factors might be a big deal this earnings.
Well, if you just take today, we had 2 pre-announcements positive. Signet Jewelers, read on the consumer, upped its guidance. Also, NVIDIA upped its guidance, and we saw very positive reaction to both stocks. So are companies fully giving guidance now? And overall, have they been conservative?
I think they've net been conservative by giving very little in terms of guidance. I think more will be giving more specific outlooks this time. I don't get too caught up in whether that matters or not. The stock market's up more than 80% since companies stopped giving guidance. I don't know why people are so consumed with the idea that the lack of guidance is a negative factor.
Well, because it made the analysts so wrong.
Yeah, but the market kind of tries to split the difference there and figure out whether analysts are slow or not. And that's also, though, why those great earnings beats in the third and fourth quarters did not get fully reflected in stock prices because they represented beating stale estimates.
All right, Mike, thank you.
Mike, great stuff. Thank you. Up next, former Cypress Semi CEO TJ Rogers will join us to discuss whether Washington can really be the solution to the global chip shortage problem. Plus, why potential crypto spike CEO TJ Rogers will join Coinbase's upcoming direct listing. The solution to the global chip shortage problem. Plus, why potential crypto spike CEO TJ Rogers will join Coinbase's upcoming direct listing. The solution to the global chip shortage problem. Plus, why potential crypto spike CEO TJ Rogers will join Coinbase's upcoming direct listing. The solution to the global chip shortage problem. Plus, why potential crypto spike CEO TJ Rogers will join Coinbase's upcoming direct listing. The solution to the global chip shortage problem. Plus, why potential crypto spike CEO TJ Rogers will join Coinbase's upcoming direct listing. The solution to the global chip shortage problem. Plus, why potential crypto spike CEO TJ Rogers will join Coinbase's upcoming direct listing. The solution to the global chip shortage problem. Plus, why potential crypto spike CEO TJ Rogers will join Coinbase's upcoming direct listing. The solution to the global chip shortage problem. Plus, why potential crypto spike CEO TJ Rogers will join Coinbase's upcoming direct listing. The solution to the global chip shortage problem. Plus, why potential crypto spike CEO TJ Rogers will join Coinbase's upcoming direct listing.
Performance coach named Jason Grease. And
All right, guys. So what we are seeing here in the market is after hours, GameStop after it spiked here just was trailing down, hit the market close about 141 right up here. That's what that number is. And then kept trickling down. It's right now at 138. I wasn't sure if we were going to see a bigger sell-off after hours at the lower volatility, or maybe a handful of people buying in after hours, trying to salvage their losses and bring it back up. I'm not really sure, or not salvage their losses, take advantage of the opportunity of the price being low. AMC kind of did the same thing. It spiked a little bit, not as dramatically as GameStop, and then it trailed down into the close, and it closed way down at 8.62, down 8.5%. GameStop closed down 11%. It was up to 6, like down only 5 or 6% here, and then it went down. Actually, I mean, I guess it opened at 158 and got to 151, so that's probably even closer than I thought. And then GameStop or AMC just continues to go down. It's at 854 now. The low for the day was 851. So not a great day. Cost down nearly 6. Right now it's at 19. Not doing really anything after.
We have a news alert on PC
news
shipments, and Josh Lipton's got the details for us. Hi, Josh.
So, well, we do have news on PC shipments. This is coming from Gartner, which is just now giving us its latest data saying global PC shipments totaled 69.9 million units in the first quarter of 2021. That was an increase of 32%. They say that is the fastest year-over-year growth since Gartner began tracking the PC market in 2000. They say that growth should be viewed in the context of 2 factors they call out here. One, comparisons against a pandemic-constrained market, and they call out the current global chip shortage, which they say is now adversely affecting the supply chain once again. They say shipment lead times for some PCs extending to as long as 4 months. But again, Gartner here saying global PC shipments jumping 32% in the first quarter. Back to you all.
Josh Lipton, Josh, thank you. We'll pick up right there because executives from Alphabet, Ford, and GM, among those attending today's White House Chip Summit in hopes of addressing this global chip shortage that's weighing on automakers and other industries. A number of the chip stocks finishing today in the red, with Intel and AMD among the biggest losers, though overall the group has been strong. Joining us now for more is TJ Rogers, former Cypress Semiconductor CEO. It's great to have you here, TJ. Looking forward to talking to you about all this news in the chip space. First, from your perspective, why are shipments of chips so globally constrained right now?
Well, now that I'm a retired CEO, I can say the truth, and that is all problems like that are because of management screw-ups. It's real simple. Obviously, if you manage things right and have systems in place, that it wouldn't happen. And that the industry is not there yet. And this correction, this swift kick is going to cause them to improve things, and this will get a lot better in the future.
Anyone in particular you're referencing when you point to mismanagement?
Well, okay, let me not be so strong in mismanagement, but yes, I will point my finger and tell you that the car companies caused this. And all you have to do is, be a chip CEO, which I was for a bunch of years. I'll give you one example how we were treated. I got a call from Japan, just merged with a company, up to my eyeballs, not getting enough sleep. You have a problem we need to talk to you about in Tokyo tomorrow morning. I got a merger. We don't care. Show up. This will count on your record. So you get in the airplane, you fly all night long, you get out in August with your suit sticking to your back, and you go into a boardroom and get the hell beat out of you by a bunch of Japanese directors. They like to be deeply involved. Okay, that's not just a Japanese story. That's a story about the auto industry. And they treat chips the way they treat tires, right? Oh, rubber, how much does it cost per pound? Yeah, we want a lot of tires. We don't want tires at all. You hold the tires until we need them. And the problem is chips are one of the most complicated things on the face of the earth. A typical video game, if you had a blueprint, literal, they don't do them anymore, but literal blueprint of a chip be 1,000 times more complex than the blueprint for the Empire State Building. And you don't just turn them on and turn them off. And it takes real smart, real well-run companies even to make them. So when COVID-19 smacks the system and everybody gets scared and they're playing the who's got the inventory game when the music stops, they pushed it back on the go for chip companies. And the chip companies say, okay, yes, boss, we'll have layoffs. We'll stop making the stuff. Problem is, the chip takes 60 to 120 days a wafer to make. 60 to 120 days from the time the round piece of silicon goes into a robotized fab and gets carried automatically through the line till it comes out. Then it goes around the world, maybe only once if you're lucky, for another 2 weeks to get turned into a chip, tested, and shipped. And there's no responding faster than that, and that's it. So when they wait and they get hit and they got hit with surprise demand, there's nothing that can get done.
So it sounds, TJ, like you're not suggesting the government is to blame, but the reason I bring that up is, can they be part of the solution? How quickly can what was discussed today help to give a solution to make the US, not face a shortage as it does now, but also be more self-dependent going forward?
Well, let me answer by analogy. Start out with, let's suppose there's a shortage of masks today. Would you trust Joe Biden to do a study and figure out the supply chain for masks and make masks better and more efficiently and give out some government money to get it done? Or would you start going on Amazon to find a mask? And the answer is, of course not. The government can't do stuff. This is, as I said, one of the most complex industries in the world. And it suffers from meddling from the government. Even meddling, throwing money at them, distorts the industry and messes stuff up. They're smart guys. They're going to figure it out. The auto guys are going to learn. They have to treat chips with more respect. They have to. By the way, Toyota did a good job. If you notice, Toyota was one of the companies that didn't announce shutdowns. And what they did is they stockpiled 2 to 6 weeks worth of chips, which is anti-Japan thinking. Having inventory is not okay, but when the cycle time to make stuff is so very long, you've got to do that. That's prudent management. That kind of stuff will happen. They'll debate internally. You'll never hear it. Who pays for the inventory? And all the government can do by politicizing the thing and having a Democratic-Republican argument whose fault it is waste time and make people think they're doing something that matters. They can't.
Got it. So you're against the government intervention and spending more money. TJ, wanted to ask you another question, unrelated, but one about executives and roles of corporations and CEOs right now. There was a call over the weekend, an emergency call on Zoom with more than 100 CEOs hosted by Jeff Sonnenfeld of Yale University to talk about how they should deal with the new voting laws, especially out of Georgia and coming out of other states. Do you think that CEOs should be speaking up and speaking out against these voter laws and getting involved more politically?
Okay, there's two levels to that question. Would I do that? No way. I run a company for my shareholders. The purpose is to manage their asset properly and make money for them, period. The Milton Friedman thing was right, and that's still what has to get done. On the other hand, if you ask me, do CEOs have the right to talk about a political view of their company, be it a conservative or liberal political view, and lobby for that? They do, as long as they're open with their shareholders. The shareholders understand it costing them money, and there's a cost to running the business properly, distraction plus whatever you spend on it, plus people that don't like whatever view you have and go to your competitors. So yes, they have the right to do it, but on that particular one, would I really go to a Yale professor and spend my weekend on Zoom trying to figure out whether or not I should politicize my company? No, I already know that. The company, your shareholders have given you money. They are going to retire on that money in many cases. And it's your job to watch that money right and grow it for them so that their retirement will be covered. And that's what your job is. And then you vote the way you want to vote. You contribute politically the way you want to contribute. And companies can contribute politically. I just don't see this politicization as being valuable. Everybody will be less well off.
TJ, wanted to pivot back to the chip shortage and the level of threat it is to the US's national security. In particular, how important, while we do transition to perhaps having more self-dependency in this area, how important Taiwan is to the US and whether there is a genuine fear of intervention by China on Taiwan that could trigger much bigger response from the US than perhaps people might be factoring in.
Okay, that was a long question with a lot of parts, and only one part of it had something that was a little bit scary to me, and that's China/Taiwan. I'll get to that last. I don't think the governments ought to be involved in this thing I don't think I know they can only hurt. I've been in this for years. I've had the privilege of testifying in Congress 5 times. And every time my testimony was the same. I was invited by the contrarians. And I got up and said, why would you give American taxpayer money to some of the richest and most well-run companies in the world? Why would you do that? Why is that fair or even reasonable? And what came from that was a vote against me. And by the way, Gordon Moore is on the other side, so it's nothing to vote against me. And a company called Sematech got made, and the government squandered a bunch of money on it. And that much happened from Sematech. That's what's going to happen from this. Second point, governments that throw money at chips do a crappy job. They don't get anything done. They've been throwing money at chips for years. You know, we're going to have Silicon Germany and Silicon France. It didn't happen. You know, they've got a 10% industry. China, you know, oh my God, what are we going to do about them? They've been throwing money for years. They've got one company called SMIC. It's a don't care company. So chips demand the free market. If players intelligently acting in a free market aren't running chip companies, then the results won't be as good. And both Europe and China have showed that. So that was the answer to all your question, but the last part, I never thought of concept of China doing some sort of power grab and taking over Taiwan. Taiwan is a free economy, and they have prospered on chips. And they have the right combination of chips to be free and have free markets work for them, but also have very low-cost labor and government policies with low-cost capital, land, et cetera. And the net result is the Taiwanese semiconductor industry has become extremely important. And losing that or losing control of that or causing that not to be free in the world would be a problem. Last point, we never have to worry about military chips. That's all scare tactics. I used to be the chairman of the SIA, and it always caused me to look at the ground when I would listen to somebody from the SIA talk about defending our military, making sure we have the critical chips. Military chips are different. They typically are at least 10-year-old technology, and they're made for a different purpose, and we will have forever all of them that we need. That's not the problem. But national security to me is more dependent on having state-of-the-art chips that make you a player in the chip world. That's more important to us because I don't think winning a war is the most probable part of our future security. I think winning the economic war and being on top is the most important thing. And there we need a vibrant chip industry. We're down to I think like 12%, but we make the most important 12% of chips in the world, the most advanced 12%. I was on your show, and that's why I was so hard on the old Intel management when Intel was giving up market share because they weren't executing, because they're a national asset. And glad they've got a new CEO and they're working on it. So yeah, the only thing you said that even gives me a pause is if we ever lost TSMC in Taiwan for some reason, that would be bad.
TJ Rogers, always good to have you. Thank you for your candid thoughts.
Thank you.
Former CEO of Cypress Semi. Still ahead, ARK's Genomic Revolution ETF up 160% over the past year, although it has fallen more than 20% over the past 2 months. Coming up, ARK's genomics analyst on his top picks in the fast-growing industry. Welcome back. Time now for CNBC News Update with Rahel Solomon. Rahel.
Hi, Sarah. Hello, everyone. Minnesota's governor has ordered a curfew starting at 7 p.m. Central Time. It applies to counties in the Minneapolis-St. Paul region. That's after police say an officer intended to fire a taser and not her gun when she fatally shot Dante Wright during a traffic stop. And before the curfew was ordered, the NBA and NHL said that they're postponing games scheduled to be played in the Twin Cities tonight. The Minnesota Timberwolves and Brooklyn Nets have not announced a new date for their game, but the Minnesota Wild and St. Louis Blues will make up their game on May 12th. Former Kansas City Chiefs assistant coach Britt Reed has been charged with felony driving while intoxicated. That's in connection with the February 4th crash that left a 5-year-old girl with severe brain injuries. And near Atlanta, traffic came to a stop on Interstate 285. Both directions there were blocked for hours after that tanker truck hit an overhead sign. Workers are cleaning up 7,500 gallons of diesel fuel that were spilled in the accident. And Wolf, apparently that's happened before. Diesel fuel leak right there. I'll send it back to you a couple of years ago.
Wow. Well, thank you. Up next, we'll discuss the genomic revolution and the stock set to lead the way when we're joined by ARK's genomics analyst. You can also tell me how to pronounce that word. We're back in a couple minutes.
Invitae in the molecular diagnostic space is probably one of the most important companies in the genomic revolution.
That was ARK Invest's Kathy Wood picking Invitae last month as one of her top picks. The stock's up 10% since she made that call. And joining us to discuss what other names in that space ARK likes right now is genomics analyst Simon Barnett. Simon, good to see you. Thanks for joining us.
Yeah, thanks for having me. And by the way, you got it. It's genomics.
Yeah, it just didn't sound right when I said that, but my producer also said that he thought it was right. But you are definitely the expert, so thank you, Simon. Talk to us about Invitae then, first of all. I mean, up 10% since Kathy told us about it. Is it still a top pick in your space?
Absolutely. So Invitae is by far one of our highest conviction names within ARKG, our genomics portfolio, but also ARKK, our flagship fund. So if we reset for a moment, one of the ways that we've designed and built out the ARKG portfolio is to understand the convergence between several different technology platforms like next-gen sequencing, lab automation, and artificial intelligence, and specifically neural networks. So Invitae is really at the center of combining all of these things together, aggregating all of the world's genomic and genetic information to truly transform and bring into mainstream medical care genetics and make it as common as a cholesterol test or going in for a physical. So we're tremendously excited about the company.
With a lot of these names, Simon, your ownership, you guys own such big components and you've had such great success, and a lot of retail traders and others follow the ARK strategy. And Kathy Wood, are you worried at all that your own ownership distorts some of the valuations, the prices for these companies?
So I think, first of all, to your point on opening up the trading, I think it's one of the things that I certainly appreciate a lot is the transparency of the funds. And we actually encourage folks to take a look and try to, understand why we invest in what we do. And I think when it comes to the ownership limits, and especially with, how great of a year 2020 was, we're actually really excited that some of these companies are able to redeploy capital, grow into new markets, expand their opportunities, and ultimately issue new shares that one can, dilute our ownership down, but also give a lot of investors the chance and the opportunity to get involved in what we think is one of the most transformative investment opportunities of the century, which is genomics.
Tell us, we've got a couple of your other picks here, Simon. Tell us about Adaptive.
So Adaptive Biotech is really interesting. A few weeks ago, they actually got an emergency use authorization from the FDA for something called T-Detect. So T-Detect is the first of its kind diagnostic test that is essentially taking the place of the serology test that we talk a lot about for COVID-19, right? So to diagnose a previous infection. But the really interesting thing about Adaptive is they combine their understanding of the human immune system, right? The adaptive immune system that is brought in anytime that we get infected or have diseases from, autoimmune to infection and even to cancer. And by applying a lot of really sophisticated machine learning principles, they've actually been able to create a test that we think will be a platform for essentially all autoimmune diseases in the coming year. So many of these are, and I'll give examples like celiac disease, Crohn's disease, have very long kind of diagnostic odysseys that can take, years to diagnose. And we think that this is a great example for a new class of diagnostic test that can be sort of a one and done, what do you have? What have you been infected with? That's really going to streamline a lot of healthcare provision when it comes to next gen diagnostics.
ADPT up 56% over the last year. Simon, so many of these charts look similar, which is they've had tremendous run-ups and they're really exciting and ARK's in it, which certainly helps build the momentum and enthusiasm. But when it comes to the actual data, clinical trials, a lot of these, especially gene editing, are in early stages, right? I mean, isn't that a pretty significant risk here with some of these names?
Sure. So if we take apart the portfolio, as you mentioned, some of them are therapeutics names that are really engaging with things like CRISPR gene editing, which is a way that we can actually treat the root causes of disease rather than just mask the symptoms. But to your point, many of these companies are earlier stage. And what I would remind people is when we are doing the valuation work for any company in any of our funds, we have a 6-point quantitative scoring system. And one of the most important kind of components of that is that 15% compound annual rate of return, right? Which is our hurdle rate. So when we're looking at the valuations that we do, out at 5 years, that's our guiding principle during volatility. And we talked about it in the beginning of 2021. Some of these valuations have kind of, curtailed a little bit as investors have looked to see how these companies are going to engage the capital that they raised and put that to work. So I would just remind folks that, we're really kind of focused in on understanding the valuation framework as well and thinking about it in the context of our hurdle rate. So for these CRISPR companies, Intellia, CRISPR Therapeutics and Editas are no different. We take that kind of risk-adjusted look at their entire pipeline and really think about how their leveraging of sequencing AI and CRISPR gene editing is ultimately going to enable them to have a more likely possibility of bringing many of those curative drugs to market.
Well, they certainly hit the buzzwords. Simon, thank you so much for joining us. We appreciate it.
Thanks for having me.
Up next, we are looking ahead to one of this year's most hotly anticipated listing, Coinbase, gearing up to go public this week, but there's a potential threat bubbling up to the company's enormous valuation. We'll tell you about it next. Coinbase is set to go public later this week in a highly anticipated direct listing. That's on Wednesday, but it does face a potential headwind to its business. Kate Rooney with the details. Kate.
Hey, Sarah, analysts do expect crypto trading fees to drop as that market matures, which could be a risk to Coinbase. A few reasons, though, why it is so expensive right now, at least compared to trading stocks. First, this is a brand new market, so some of the clearing infrastructure isn't quite there yet. There's also no payment for order flow, and there are higher costs for things like security and custody. The final thing, which is basically holding Bitcoin, is more complicated and more expensive with crypto. Platforms tend to charge between 1 and 2%, and they also make money off of the spread. In Q1, Coinbase, for example, made almost all of its revenue on trading fees alone. Analysts at New Constructs highlight revenue concentration as a big risk here and predict a similar dynamic to what we saw with Schwab, Fidelity, all of the retail brokerage firms a couple of years ago, with fee slashing to gain market share and to keep customers. Wilf, back to you.
Kate, thanks so much for that. Still to come, some key inflation data on the docket for tomorrow that could have big implications for your money. All the details coming up.
Final thoughts on the markets next. And a quick programming note for you. On May 11th, join CDC Director Rochelle Walensky, plus leaders from Pfizer, Eli Lilly, and more for the Healthy Returns Summit. Visit cnbcevents.com/healthyreturns to learn more and register.
Lots to look ahead to tomorrow, including the March CPI data. Key read, of course, on inflation. Analysts expecting the annual rate to grow 2.5%. And Mike, 20 seconds or so left. Inflation tomorrow, earnings really dominate the rest of the week.
Yeah, they will. And, you know, I don't remember a big anticipated number where economists and everybody's, including the White House, saying, hey, don't pay attention to the details because of base effects. We'll see if the market actually takes that to heart.
Watch the month over month. We know year over year is going to be a big game because of the comps. That does it for us on Closing Bell. Fast Money begins right now. I'm Melissa Lee, and this is Fast Money. Tonight's trader lineup: Guy Adami, Tim Seymour, Karen Feinerman, and Dan Nathan. Tonight on Fast, let's make a deal. Microsoft shelling out $16 billion for Nuance Communications. So that got us thinking, what should be the next tech tie-up? Our traders have some ideas. We'll bring them to you straight ahead. Plus, an all clear for Alibaba, why one of our traders is calling a $2.8 billion fine the best news we've seen in a while. And later, time to ante up. DraftKings falling 6% today. The stock is now down nearly 20% in the past month. So should you double down on this pullback? But we start off tonight with a semi-smackdown. The gloves coming off in the battle of the chip giants as NVIDIA fires a direct shot at Intel. Let's get straight to Josh Lipton with all the details. Hey, Josh.
So, Melissa, CEO Jensen Huang has transformed NVIDIA into a true powerhouse with that company's graphics chips. These are processors that generate images and accelerate AI. Now, NVIDIA plans to make its own server CPU, too. Those are the primary brains in most computing devices. NVIDIA also saying today that its first quarter revenue is tracking above its previous outlook of $5.3 billion, and that stock posted its best day here in over a month. Some investors clearly saw NVIDIA's announcement as a direct shot at Intel, which reported $26 billion in revenue from its data center group in 2020. That was a jump of 11%. That stock just had its worst day since late February. So how bad is this news, though, for Pat Gelsinger? Tech analyst Patrick Moorhead countering that his company still does boast certain advantages. NVIDIA, with its new server CPU, is targeting more of a niche market, Patrick says, and Intel is still the giant, dominates about 90% of this market. No response from Intel on that NVIDIA news. There was also that big White House chip summit today. Remember, President Biden's infrastructure plan does include $50 billion for the American chip industry. Melissa, back to you.
Josh, quick question on the niche market point. How big is this market, or how profitable is this to make this such a big deal that they're going after specifically this narrow part of the market?
You're going after what's called the HPC market. So that is a market that would include things like national laboratories like Los Alamos. That's why Patrick Moorhead in his point was saying, one, these are different. Intel is dominating about 90% of that server CPU market. And Patrick's point is that Intel's focus is different. It's really targeting more general business uses and cloud providers. But we'll see how it plays out, Melissa.
All right, Josh, thanks. Josh Lipton with all the details there. Guy Adami, it was interesting to see how Intel traded, because as soon as that release crossed from NVIDIA, stock dropped like a rock.
Zero-sum game. I mean, not only in terms of Intel's move, but, you know, Qualcomm got a downgrade today. Stock didn't trade well. Obviously, AMD didn't trade particularly well. Texas Instruments has been hanging in there. I think what the market is saying is, you know, who's the leader here, and who are we really going to get behind in terms of growth? NVIDIA has a huge valuation. I think we all agree, but it's also might be the most exciting tech name or chip name. BK spoke about that in early March, by the way, about 20% or so ago. I still think there's value in an AMD. I am surprised at how well Texas Instrument trades with 8% EPS growth at a 27 multiple. And just for you playing stock market at home, note that today's
All right, guys, let's talk about what's going. First of all, we're talking about the microchips here, which, man, I just realized I blew up my picture here, but didn't never minimize it whenever I brought think I swim back up. Anyway, they're talking about this microchip thing. And first of all, I guess it's good that I've seen NVIDIA go up because I own stock now in NVIDIA, and it's finally actually turned out to be a profitable stock. And I bought it just at the wrong time at the beginning of March, which sucked. But man, the chip shortage thing has really become a serious issue in a lot of places. And it's funny because, you know, I don't think too many people really realize how many things have these chips. I think that you know, now it's greatly hurting the automotive industry, but I think there's so many others. Any of the type of automation type of business, it's hurting. Obviously, computers and computer building and computer manufacturing as well. So it's becoming a lot, you know, which is pretty crazy. The chip shortage is making as big of a dent in the economy as it is. But I guess maybe it's a good time to have NVIDIA stock. Maybe the demand is helping it. Anywho, let's look at what we got here on the market. I was not sure what was going to happen with GameStop after the close. I honestly did not know what I was going to expect after the close. It's just, I didn't know. I mean, I knew obviously volume was going to go down. Does that mean it was going to translate into, you know, the price going back up, having like a third spike today, or was the price going to continue to go down and actually take even more because all those people, you know, the people trading after hours are usually not the folks, because first of all, I don't even know if Robin still allows after hours trading. But even if it did or didn't, the normal retail traders are not the guys doing after hours trading. So, you know, you might see some people just sell off. People that are willing to still be in it after hours and making trades, they might sell off. It's not really what's happening. It did go down a little bit. You know, it closed officially at 141. It's currently sitting at 139. So you did see it continue to trend down filled out right here at 137, and it just kind of is drifted sideways a little bit up, not much. AMC kind of did the same thing. It just tanked right before the close, ended up closing at 862, drifted downwards again to like 852. Sorry, no, it closed at 862, drifted downward to 852, and it's back up to 861, so just a low when it closed at, and it's not doing a whole lot. KOSS, kind of again the same thing. KOSS did not have a great day. I guess it could have been worse, but it was about 6%. Volume was terribly low. Nothing really going on. Express has had the most interesting after hours right here. We'll see them in just a little bit here. I mean, volume's obviously just terribly small. It's one trade right here. What, 4,165? That's not one trade, but there's trades in it. And it's this huge spread right here, this bid-ask spread of 3.6 to a 3.56. You can see the numbers right up here on the screen. And by percentage-wise, it's a big spread. But there's just no volume. I usually when there's such little volume in something like this after hours, you'll probably see it start to slowly trickle downwards. The good news is, let's say I was like on the verge of needing Express to be, maybe I need to get to like 3.61, 3.62 in order to sell. So there's enough people out there selling Express, trading Express, to probably get some sort of a market, reaction. There's enough volume for that. But I really need to get like a couple of extra pennies per share. That's when you go in there and you put in a couple of trades. One trade at 3.6 or 3.57, 3.58, 3.59, 3.56, and then you trickle it up a little bit, and the majority of what you have still might hold at 3.6. And that's like your target. Then put in like double at 3.62, double at 3.65, 3, and you can basically stair step your own stock up because there's enough people out there that even though it's beyond the bid-ask spread, there's enough people out there that will be willing to bite on those small increments and change. And so I've believe it or not did that once before. I've done that a couple of times. Once before I did it, and I actually got a stock relatively high. And again, it happened after hours when the volume was dead, but the volume was enough to where there was still trading happening. But the amount of shares I was putting in, because these were shares that were all worth no more than 80 cents. So I had hundreds of shares at a time. I was dropping in. So hundreds of shares at a time I was dropping in. Someone's there to pick them up, and I was just stair stepping it up. And I would, probably from like 0.78 to 0.5. Sold off all the shares, so it worked out in my advantage. We're also seeing a little bit of an increase after hours increase in TQQQ. It does a really good job of using momentum to continue upwards after hours, pretty much. So that's really good to see. It's up to 1.10705, so that's good. So we'll continue to watch here for a little while longer, see if anyone wants to check out the CNBC. Otherwise, we'll sign off pretty soon.
Add complexity to the antitrust around NVIDIA ARM? I mean, is that something that you think makes this deal more complicated? Obviously, not challenging Intel or a challenge to Intel and data center. That's welcomed, I'm sure, on some level by the industry. But to the overall dynamics going on between this, as you said, takeover they're trying to get done, do you think this complicates that?
I think if anything, it can speak to the fact that they're innovating so aggressively within the ARM ecosystem. If you're a partner and you're seeing them innovate like this and deliver this kind of product roadmap, you're going to be happy, and they're courting their partners. So I take that as an incremental positive in terms of just the progress that they're trying to make with respect to regulatory. I think the big hurdle is going to be China. Can they get SAMR approval? You saw Applied Materials and Kokusai got rejected from a few weeks ago. So I think this is going to be a long, drawn-out process. They laid out about an 18-month timeline, so we're still very early days, but I think it's an incremental step in the right direction as they secure partner ecosystem approval.
Hey, Jared, it's Dan. Thanks for joining us, bud. Hey, so as far as semi-equipment stocks go, how would you see this changing any of the deck chairs that are set up. We know that Taiwan Semi keeps raising their CapEx, so there's some major tailwinds right now. How would NVIDIA's entrance into this market and the closure of the ARM deal, what does it mean for semi-cap equipment stocks, any in particular either?
For sure. When you take a step back and you look at the semiconductor capital equipment landscape, including Applied Materials, KLA, Tencor, et cetera, they're in a very good position right now. When you think about the fact that we're in a significant shortage, we obviously had the summit at the White House today with multiple executives from the automotive industry and the semiconductor industry talking about when they can alleviate that shortage. It plays into the fact that we're going to be in shortage for at least the next 6 to 9 months. So cyclically, they're in a very good spot. But it's an interesting question, Dan, because from a structural standpoint, you think about artificial intelligence and HPC type workloads, they're going to be using and leveraging silicon that's significantly larger in nature on a millimeter square basis. So what that means is that the demand for semiconductor capital equipment, the intensity is only going to increase. So this is no doubt a long-term structural positive tailwind for the entire semiconductor capital equipment landscape.
It sounds like you think there's more upside to semi-cap equipment as opposed to semiconductors.
They're just in a very sweet spot right now, not only for the cyclical benefit. And if you listen to Applied Materials Analyst Day that was hosted last week, they talked about $85 billion in wafer fab equipment spend over the next few years. And you also have multinationals, right? You have China, you have the U.S., you have Europe looking to add capacity from a national perspective in terms of just nation-backed foundries. So they've got very significant tailwinds at their backs.
All right, and while we have you, Jared, got to get your quick thoughts on Microsoft for Nuance. What do you think of this?
So yeah, listen, second largest acquisition in Microsoft's history behind LinkedIn, and it's all about augmenting their total addressable market. So augmenting Microsoft Healthcare Cloud, they're doubling their TAM, their total addressable market, to $500 billion, combining Nuance's AI algorithms with Microsoft's leadership in Azure on the cloud side. And so not only are they attacking the healthcare market in a pretty meaningful way, leveraging the existing Microsoft capabilities, but they're bringing very significant and critical IP towards Microsoft Teams. So if you think about Microsoft Teams, which is the competitor to Slack, Microsoft's all in on Teams, to the point where even Satya Nadella's comp package is now based on Teams performance. So they're going all in, increasing and augmenting the capabilities from a team standpoint, and they're going to be able to integrate that seamlessly with Nuance. I think it makes a lot of strategic sense.
All right, Jared, great to see you. Thanks for your thoughts.
Thank you.
Jared Weisfeld. I think that was interesting in terms of Satya Nadella's compensation is tied to Teams, and what would that mean to not just a Slack, but also to a Zoom, let's say. Dan, what do you think?
Yeah, I mean, this is a pretty sneaky little acquisition here. $20 billion with debt and everything like that. It's a rounding error on Microsoft's, market cap and even on their balance sheet. And I think Jared laid it out why they're doing it here. They're adding some capabilities. Azure is becoming more and more of a competitor. That's one of the reasons why Microsoft's almost a $2 trillion market cap. So to me, this makes sense. They can basically do whatever they want. They were looking at the TikTok. They were looking at Discord. They were looking at a few things. This one, it's like literally 1% of their sales, but it means so much more to them if it's done properly and gives them the access to some of these markets where they think they can flex with their cloud. Yeah, they wanted to do something. It was very, very apparent. And Karen, maybe the biggest tell is the movement or the lack of movement in Microsoft's stock in response to this deal.
Right. Well, if you think about it, it's an all-cash deal. So they had cash sitting on the sidelines, basically earning nothing. And they could buy this, which is strategically really important. They said it would be dilutive 1% in the first year and then accretive thereafter. And it's still, there would be no change in the company's $20 billion buyback. So to Dan's point, they can do whatever they want. This makes sense to me.
All right. Well, this $16 billion deal for Nuance got us thinking, who should be the next tech tie-up? So we're going to play a little game of Let's Make a Deal Tech Takeover Edition. Each trader has come up with their perfect pair. So we want to kick things off with Karen. What are you thinking?
Yeah, I got it. Perfect pair. So it's Peloton and Tonal. So I know it's not, you might not think of it as tech. Of course it's tech. It's not just a bike, right? It's a consumer tech product. They already have the bike, obviously. They have the treadmill. They have the classes. But what they don't have is serious weight training, and that's what Tonal is, and it just fits on your wall. So, Dan, you could have it next to your treadmill, and it makes perfect sense that they would integrate all these aspects of being fit and have your own little gym And if Peloton buys Tonal, they could be Pelotonal. See? Meant to happen.
Well, the name is pretty catchy,
Just saying.
Pelotonal. Yeah. Dan, what do you think, since you are a Peloton user?
Well, I'm obviously, do the weights too. You can just tell. So to me, yeah, no, I think that makes sense. I think, we were talking about it earlier. I think the Lulu mirror thing was really interesting. Obviously, Peloton is buying that Precor. So, I mean, they're looking to beef up whatever they have, but I've already beefed up here over.
I mean, your suit will rip off your body if you continue to do what you're doing. Tim, let's go to you in terms of your tie-up. What do you think?
Yeah, so mine's a fintech tie-up, and to me, this is Square buying LendingTree, and to me, this deal makes a ton of sense for both capital markets reasons and I think a fit. Ultimately, look, Square's Cash App is the kind of the one-stop stickiness that's allowed this company to grow, and ultimately means you never have to leave. Why not layer in LendingTree, which is a $3 billion company, well off its highs, had a lot of run into its last fourth quarter numbers, frankly, disappointing on margins, disappointing on earnings. The stock has collapsed, and yet this is a full suite of products in consumer finance, and whether it's lending, whether it's insurance, this makes a lot of sense to me. I think for the profile that Square is building, and again, Square in terms of that stock, using that as a currency after effectively being 3 times where it was pre-COVID, we know what they're doing in terms of this overall strategy, and I think this makes a ton of sense.
All right, Dan, your tie-up.
Yeah, so, there was a headline last week that Amazon is about 10% of the U.S. ad market right now. They're just a behemoth. They're going to do $16 billion in sales here. I think that Twitter and Snap ultimately have to merge. Those two combined have about $9 billion in expected sales. Most of that is obviously digital ads right here. Now, listen, I used to think that an Alphabet or a Facebook or maybe even an Apple might buy one of these guys. But with the regulatory oversight on some of those big social ad names, I just don't see it. So with Amazon coming up here, they're going to become a behemoth. And I think that you're going to need to see Twitter and Snap, which really don't have overlapping products. I don't think that would be an issue with just kind of regulators here. I think they need to beef up, and I think that they could be a meaningful competitor to Facebook and some of the properties that Google has.
That's an interesting one. Guy, how about you?
Well, I should say pick me, Monty, for you Odd Couple fans out there. That's an homage to Monty
Yes.
Hall, number one. Number two, all these deals are fantastic, but listen, they all have integration risk, potentially regulatory risk. They'll get past them, and I love the deals. Here's one that has no integration risk and no regulatory risk, and this company would spend 10% of their cash hoard. That would be Apple buying the Bitcoin. And it's interesting, you hear Michael Saylor from MicroStrategies talk about balance sheets being basically turning a negative into a positive when they transform their cash positions into Bitcoin positions. $25 billion for Apple is 10% of their cash hoard. It's nothing. And I think the ramifications would be huge, not only for Apple stock, but for the industry as well. So that would be my sort of off-the-chart tech wrap-up, or what'd you call it, meet-up or something? I'm not sure what
Let's
you
make
called
a deal. But would the implication be that Apple eventually accepts Bitcoin as payment, or will use it maybe as part of its payment system?
Does that not make sense? Isn't that seamless in terms of what they're doing going forward? And listen, Michael, again, go back and look at some of the things that Michael Saylor said about balance sheets and the transformation thereof. And for Apple, it'd be a small foray into something that could be potentially huge. So I actually think it makes a lot of sense.
All right, coming up, Palantir feeling the pain, the stock falling nearly 3% today, but we saw something bubbling up in the options market that suggests a turnaround is in the works. We'll bring you the trade, but first, if you don't own it, buy it. If you do own it, buy some more. That's what one of our traders says you should do with Alibaba. Why a $2.8 billion fine is actually great news for investors. All that and more when Fast Money returns. Welcome back to Fast Money. Alibaba topping the tape today. The company hit with a $2.8 billion fine by Chinese regulators as a result of an anti-monopoly investigation. Now, Karen, you're saying that it's the best news we've seen for Baba in a while. Why?
Yes, because, basically think of them as a metaphor, being on trial. And the trial's over now, and they got the tiniest slap on the wrist, and it's over. That's it. So when we look at December 20th, the stock was 256, and then this announcement of this antitrust investigation was announced. Traded down to 220 that day. Now, if I had told you, or me, because I was a sad holder that day, that there would be a less than 1% penalty, and then the investigation would be over, I'd be pretty happy with that outcome. So I'm pretty happy with this outcome. And I think that where the stock opened today, it really wasn't fully reflecting. I think it's on its way back up now. We had also Ant Financial had some clarity there as well. I do think Ant Financial, the value has been somewhat diminished, but not nearly as much as the overall stock in Baba has. So I was long going into today. I bought some more today. And I didn't quite get as much as I wanted, and it kind of took off a little bit. But this is very, very good news.
Yeah, we got to go to the ambassador as well for his thoughts on Baba, Tim. And is it too early or too soon to say it's an all clear for Chinese tech in general, or is there still an overhang that regulators go after other tech companies?
Look, I think this, at least from Samer, I think this investigation is closed. And as someone that's been investing in emerging markets for a long time, I love to see these kind of settlements. What I didn't want to hear them say is actually we dispute the findings of the anti-monopoly group, and we're going to contest this. That's the worst thing they could have done. I love the fact that, in fact, the headline I saw said something along the lines of, we thank them for their guidance, and they will move on, and they'll thank them. Thank you, sir. May I have another? This is great news. This is what you want to see in an emerging markets environment where Big Brother certainly can do what they want here. I also have said all along, I actually think that they are guilty of this. I actually think that what the regulator is doing in China to build a proper, support the tech industry, to build an e-commerce industry, I think is the right thing to do. And I also am long Alibaba, and I think buying it on this news is important.
Yeah. So, Guy, what do you think? Is this really the all clear for Alibaba, or does this tell you that regulators can effectively come in and fine you for anti-monopolistic practices, et cetera, anytime they want to?
Yeah, it could happen again, right? But the markets learn how to deal with it. I think Karen makes a great point. I love it when she cites levels, because that 220 level that she talked about, if you go back to January 2020, the stock made an all-time high right around 225 and then sold off pretty precipitously. So past resistance becomes support, and we found it in the wake of $220 a share. So I think you have something to trade against, and I do think it's the all clear. So I'm with K-Fine on this one for sure.
What do you think, Dan? A basket of Chinese internet stocks or a basket of U.S. internet stocks?
Probably China here, and I think a lot to do with the fact that the sentiment's really bad. They performed really bad. But I don't know if you remember this, Mel. We used to have this chart formation. I used to have a graphic. I don't know if they can find it. Remember the triangle of death? This chart really does have the triangle of death chart. Now, 220 is clearly that neckline. If you want to look at a one-year chart and you look at the left and the right shoulders, and Guy, you know that left shoulder can have two shoulders here. So I look at that downtrend. You might have clear sailing up to 250, but if it gets rejected there, you might see another retest of the 220 level, and just watch out below if it gets below there. That being said, I prefer the Chinese internet because of the underperformance over the last few months.
That left shoulder could have two shoulders. That sounds pretty bad. That sounds awful. Sounds like an awful formation. We've got a lot more ahead. Here's what's coming up.
Uber shares driving higher as the ride-hailing company posts record bookings. Is this the ultimate reopening signal? That trade ahead. But first, one top strategist is calling this market the strangest he's ever seen. What odd phenomenon is he referring to? And what's his playbook? Those details next. We've got that and a lot more when Fast Money returns.
Welcome back to Fast Money. Stocks finishing the day in the red as investors gear up for earnings season, and the setup has been strong. The Dow and S&P 500 sitting near record levels. And our next guest is questioning the level of market exuberance, calling it the strangest melt-up he has ever seen. Julian Emanuel is BTIG's chief equity and derivatives strategist. Julian, good to have you with us. Strangest you've ever seen in your entire career. Why?
Well, basically, if you look at the month of April, it's just an incredibly strong month and really almost straight up. You know, today was just a tiny pause in the uptrend. And when you think about that kind of melt-up type action, what you would normally expect is rising volumes, rising enthusiasm, rising call volumes, especially since call buying on the part of the public has been a big story of the last 9 months. And we've got just the opposite. And so it really is a puzzler. On the one hand, we think it's actually a positive sign because what it says is that bigger picture, this isn't sort of the end of end rallies of what's only a 12-month bull market, when the average bull market lasts almost 4 years and rises 150%. We're up 85% in 12 months. But at the same time, it's a little bit more cautionary when we think about the potential for earnings season to be an upside catalyst. That's not likely going to be the case in the weeks ahead.
Julian, it's Karen. Let me ask something you said about volume. So if the volume were much greater, then would you be thinking the market is reaching a peak?
We would be thinking likely there's more explosive upside, given the fact that when you think about it, we've overcome just a number of things, rises and falls in the meme stocks, rises and falls in EVs, SPACs, solar stocks, all of these things that, essentially have been quite speculative. But if we were seeing rising volume and rising price, we would say there's more to it. But that having been said, with the VIX down around 16, 17, you're still looking to put on downside hedges in case the music stops. And when the activity gets frenzied like that, you don't ever know when the music's going to stop.
Julian, Elon Musk asked Kathy Wood a pretty much a rhetorical question. I think at least he knew the answer to, let's put it that way, about market cap, the S&P market cap over GDP. Does it matter? We had an interesting conversation last week about it. Does it matter? Because as we sit here, we're somewhere between, 165%, 180% S&P over GDP. Market seems not to care. Should we?
When it comes to valuation metrics, what we've seen is the market doesn't care until it cares. The question is, what's going to get it to care? And if we go back to the beginning of the year, we've had these hiccups every now and then when yields started rising perhaps a bit too strongly. Now, if we go back to Chair Powell on television last night, that's not likely going to be the case that we're going to have yields rising strongly. What it says is that if you're committing new capital to the market right now, you shouldn't expect a profit right away. What we've seen, though, is that when you've had a paradigm of the market's sustained valuation at this extreme for a long period of time, again, this early into the bull market cycle, what we're likely going to have is a period of digestion before we move higher. But it is the market saying that it expects earnings, and particularly now economic growth, to catch up with valuations.
The notes that I got from our producer here, Julian, were very interesting because it says that you are very, very, with the very, very in all caps, bullish on Bitcoin. And so I'm wondering if let's say somebody at home had, a sum of money, let's just say $10,000 for argument's sake, to put someplace from now until the end of the year, would that be in U.S. equities or would that be in Bitcoin?
So here's our view on Bitcoin. Long term, we think the story is very sound. We think that it is likely to become an increasingly more important percentage of someone's assets. We think for now, there's some digestion to be done. There's a very important IPO coming out this week. We want to see how digital assets respond. We would say that with both U.S. equities and Bitcoin, you need to think long term. We do think both are going higher. We do think that Bitcoin looks quite strong into next year. but don't buy it just because you think this IPO is going to be successful this week.
Okay. Julian, thank you. Julian Emanuel of BTIG. For somebody who thinks Bitcoin is going to be at 92 grand next year, Tim. I don't know. It sounded like Bitcoin to me. But what do you make of Julian's assessment of this melt up?
Well, first of all, April is seasonally always a great month for the market, always often is. And May and June often can be awful months. So, look, the expectation of this earnings season being remarkable is something that I am concerned about. I'm more concerned about the point in which analysts and companies themselves have actually started to talk about normalized earnings. So I do think you have, for example, let's take the financials. Banks have rallied dramatically into this. I own money center banks. Do I expect their numbers to be good? I think they're going to be great. I think banks, if they follow the script that they followed, and they typically follow or have in the last 6 or 7 quarters, they're going to trade down on this news, and it's going to take them 3 weeks into earnings season for them to pick up steam again. And I think that's kind of where we are with the market.
Yeah, and by the way, they always trade. It always seems like they trade down on earnings, Dan.
Yep.
That's the pattern.
Yeah, they do. I think it's like Tim outlined. I think it's a particularly hard setup for a lot of companies that are, especially sectors that have done outperformed. I'll just mention one thing, about Julian's caution near term about this, what feels like euphoria. It's really hard to find bear cases for the market right now, like really hard. He talks about in his career, he hasn't seen this or that. I can't remember a time where just the universal bullishness, because of so many odd things that have happened, specifically over the last year, namely $6 trillion in stimulus, which is, about 30% of the market cap that we have here in the U.S. And I'll just make one last point. This year, although we are up nearly 10% in the S&P 500, we've seen 2 massive dislocations in the market, which is really actually should be very worrying to a lot of people about market structure. The first one in January about shorts, and then the other one, obviously, with Archegos about longs. And if you think that Archegos is the only fund out there that has very concentrated, very levered bets in stocks that have appreciated a lot, you got another thing coming. So if there is a reason for the market to sell off, then you remember that whole thing about total return swaps and the kind of opaqueness that we see there? This is going to be an issue here. So I don't know what the reason will be. I'm not calling for a big decline, but the market structure has been tested this year in both ways, and I don't think it's really held up particularly well right now.
Coming up, best month ever. Uber driving in a record number of bookings for March. Should you speed into this name? We got the trade ahead. Plus, shares of DraftKings dropping. The stock is now down nearly 20% in just a month. Time to ante up. Stick around. We've got all that and much more when Fast Money comes right back.
Guys, we are getting nothing here after hours. I think we're going to wrap things up because there is nothing going on after hours today. Let's see how the market really ended up. Again, it's been closed now for quite a while, but let's see where we're at. Overall, the primary indexes did all end down. However, they were all pretty sideways. The Dow was only down 55, NASDAQ 50, and S&P less than 1. So I guess technically not a record close for the S&P, but less than 1 point away from it. So that's kind of funny, actually. Did it hit a record? It might have hit a 52-week record though intraday, either midday or right before the market closed. It was up. But yeah, I mean, it's the all-time high happened today. I just don't know if it happened at the 12:45 peak or the 3:55 peak. But man, let's see what went well. Well, Bitcoin was back up to 60. It went below there for a moment. It's back up. So for the most part, the cryptos were sideways today, but they were up big over the weekend, especially Dogecoin. Treasury rates went up slightly, but nothing crazy. I think there was some worry that they were going to go up a lot more today, and they really didn't. Amazon actually finished up today, so Amazon's had a really good run the last few days, but the rest of the bank stocks ended down. Uber, I don't currently have any in Uber, but I do watch it every now and then. So Uber was up today, Tesla was up today, Peloton was up today. So yeah, some of the growth innovation stocks were up today. DoorDash was up 5 points today. ARI, Apollo Commercial Real Estate up 1%. Some of the losers today, though, were the meme stocks. Anything meme-ish related, even Churchill Capital was down 4%. Bumble down 2.5%, Neo down 2.5%, GameStop, BlackBerry, Bed Bath & Beyond, AMC, Express, KOSS, Nokia, and Naked Brands all down. Right, blockchain, MicroStrategy were both up at as high as they were earlier today. And my stock that I'm watching closest right now is Voyager, is down 2% today. We will see what happens with Voyager. Overall, my portfolio is just down slightly, maybe down 0.2 or 0.3%. Nothing crazy. Um, some of my biggest holdings like Zoom was mostly sideways, but I had others that did really well. Tesla, Twilio was up, oil stocks were up, Square was up. SPXL, even though the S&P finished down slightly, the SPXL was actually up. It's kind of the swing of triple leverage. Nvidia was probably the biggest gain by percentage, nearly 6%, 60%. Then I had a lot of others that lost more than that percentage. Fizz, one of the lesser known meme stocks from the surge in January, FIZZ, was up slightly at 4%, but it's still down a lot since that time. Let's see. DocuSign was up, Dillard's was up another nearly 1%. So I'm nearly at a break even on Dillard's. That's exciting. CCL Carnival was down 5% today. What happened with the cruise liners? Yeah, they've had a little bit rough go of the last 4 days. Actually surged at more than last week. AXD is another similar meme stock is down 6% today. So that's like anything meme related is pretty much down. AMC finished at 8.5%. GameStop finished down. Sorry, my screen just flashed in front of me, but GameStop finished down nearly 11%. It's trending down more after a while. So overall, not a great day, but it could have been a worse day. Relatively sideways day. The stocks we watch here, meme stocks all down. TQT2 was just barely down. You almost look at it as a positive day, it's down so little. So we'll see how tomorrow goes. Hopefully we'll have some tacos here tomorrow, Tuesday.